we finish the chapter 19 handout, I'll send that out. Okay. So I think we're number 8. Okay. And by the way, this pension stuff is it's difficult, but at the same time, the thing you got to just keep in mind is it's kind of like putting money into a piggy bank that someone's drawing out. You know, you put the money in the piggy bank so that you can pay your retired employees, and you have this liability that is retired employees, and that's all it's in the piggy bank: assets and retired employees. You know, you owe money to. And so, you know, how the money that you put in, you invest it, hopefully it'll make a return on it, on the money you invest in there. And then, but also on the other side, the liabilities go up because you have people still working. And like any liability, as you know, as time goes on, they can have a change in the amount of liability that's owed to people, because you got people earning money in the current year, earning pension in the current year, but you're also paying off some of those people out of the pension. So, you know, it's kind of like almost like a piggy bank. Company throws money into the piggy bank, and hopefully there'll be enough in the piggy bank to cover the pensions. But it's separate from the company. Now, this pension asset liability thing, this happens because of the pension assets might not be larger than the liability. So that's when you come up with the underfunded or overfunded, you know, liability or an asset, depending on which side it goes on. But it really is pretty, it's not as difficult. The terminology is kind of weird, but anyway. Okay. Prepare the journal entries for the following benefits. All right. Well, actual gains and losses, and this includes the plan asset, unexpected gains and losses in the plan assets. Oh, okay. So let's go ahead and take those first. I'm gonna bullet this. Okay, so plan assets. Expected return on plan assets is 10%. Okay, so we're going to take this. So this will be the expected return. Now let's look at that expected. Okay, the actual return was 68,000. So is this an unexpected gain or unexpected loss?
Gain.
Gain. Yeah, they thought they were gonna make 62,000. I ended up making 68. That's 6,000. Okay, so we have an unexpected gain of 6,000. Oops. We have an actuarial gain of 21,000. This usually happens when this settlement rate changes. The settlement rate changes. We have an actuarial gain. And I think I told you guys this. You know this stuff from actuaries. So when they say actuarial gain, it really is someone hands it to you and says, "Here, this is your this is your gain, or this is your loss, or whatever." You don't accountants don't do those calculations. Okay, so it looks like we have 6,000. What was it? 27,000. Okay, now there's actually accumulated comprehensive income debit. This is a loss. If it's a debit, it's a loss. All right, so if you combine the 30 loss and the 27,000 gain, you're still at a $3,000 loss. And there is a 10% corridor, which means 10% of this PBO. If it goes more than that, you have to jump through some hoops. You're not going to see that in this class. It's there for when there are really wild swings in the market. That's what that 10% corridor rule, they call it. That's what is there for. And quite honestly, usually it washes out within a couple of years at most. Sometimes it washes out by the next year. But anyway, it's on the books there, in case it does happen. All right. So let's take a look here. So we have a gain of 27,000. Okay, so pension asset liability. We have a debit of 27,000. Other comprehensive income. This situation, it's a gain of 27,000. And we got that by the unexpected gain of 6,000. Plus the actuarial gain. What did I mess that one up? Okay. So those two together are the 27,000. They're both gains. This will be a gain. Okay, pension expense. Oh, I didn't correct this. Service costs. And that's what people have earned in the current year, 110,000. Oh, how weird. It's a different font. Who made this stupid thing? All right. All right, so service cost is 10. Interest on the PBO. Okay, so like any liability, there's an interest rate on it. Any long-term liability, there's gonna be interest rate, and an interest rate on this one, and the interest rate is 11%. So the beginning liability. Oops. 10,000. 10% would be 90,000. Yeah, 99,000. So this is our interest rate basically on the liability. This is just the liability. This is what we owe the pensioners. We owe the pensioners 900,000 at the beginning of the year. And the settlement rate, which we get from the actuaries, is 11%. So that is 99,000. The expected return on assets, 62,000. So this will actually subtract from our expense. Actually, I should probably put it, these are pluses. They add to the expense. This one says, well, wait a minute, we have our assets earning some money. So because our assets are earning the money, it's less that we have to throw in. Amortization of prior service costs. I don't think, oh, we do have that. I'm sorry. Yes, we have that right there. So amortization. So these are prior service costs that we recognized in the past. And as they earn it, which we're going to learn how to do next in a few minutes. Each year we're going to take a portion of it and recognize it in our regular expense. So in this case, it's 20,000. I'll tell you something unusual about that nowadays. And that is, in somewhat recent times, there's been a lot of givebacks into pensions. You know, companies will negotiate, okay, we'll keep this many jobs here if we can get out of this many pension costs. Sometimes the prior service costs now are, they reduce the actual amount that's owed. So sometimes you'll have kind of like givebacks, basically they call them, in the pensions, and that's it used to be very rare, and now it's more common that, you know, it's kind of a negotiated thing that I'm tipping over or something. Companies are so this can actually be pluses or minuses depending on you know, the structure of it. Normally, though, if it increases it, it's going to be a plus down here. And we don't have any of those. And so the total of this will be $167,000. That doesn't look right. Let's see. It is right. No, it's not. Let me try this again. See, not only do you get to see me learn how to use a computer, but also how to use a calculator. That is right. Okay, so pension expense. So down here we have pension expense. $167,000. Cash we paid out. This is our cash. So our cash we paid out is 150,000. So coming down here, our cash. Yeah, notice that the cash payout is not part of the pension expense. Just that quick, I forgot. 150. Okay, this amortization of prior service costs. So here's the wacky thing. Whatever the prior service cost was, it's already been recognized in the liability. So when we recognize it in our expense, we're actually recognizing that we owe this amount in our expense. We had to take it out there so we're not double dipping, because it will add to this pension asset / liability. It'll double dip if we don't take that out. So this is the by the way, if you want to abbreviate this, PSC, that's fine. Prior service cost. And then we have a plug number. What is it, 173,000 debit. I think I told you guys this, when I took the CPA exam, I didn't understand pensions at all. And so I memorized this. And I think they only put like one multiple choice question on for it. But you know, and that's one thing about the CPA exam. Either you know the stuff or else you memorize it. And this is one of the things I memorized because it didn't make any sense to me. And I think I told you guys last week, I worked at Navistar and we had bazillions of dollars in pension liability. So it was a big deal. And I actually worked on the audit with Deloitte Touche on doing it. As a matter of fact, I did the test of controls for the pension. The pension was huge. We had 35 pensions. We had 39,000 pensioners, and it's not that I was an internal auditor. I worked for Navistar, but I also helped the external auditors. And there's nothing wrong with internal auditors helping the external auditors. Some people didn't like it, but I liked it. It was fine with me. But anyway, so I worked with them. Two of our audits that I was involved in. But anyway, I did the pension test of controls for the pensions, and there's nothing wrong with having internal auditors do that stuff. You have to make sure that they're objective, which I was. You have to make sure that they're competent, which I was, and you have to make sure that you know that basically we're also you know, I have the ability to the controls to ensure that we're doing the right thing. I know it sounds funny, but there's being competent, and then there's also control activities. Competence is that you can actually do it. Controls are that you actually do what you're supposed to be doing. So, you know, we had all that. But anyway, it's not uncommon. Now, I couldn't make any judgment calls. So I just did the testing. You know, they wanted to do the testing. I wrote it all up. But they make the judgments. Like, you know, if there wasn't any problem with any of them. But if there were a problem with any of them, they would be the ones that make the judgment call of, can we rely on this or not? One thing about pensions is they were such a huge expense for Navistar that they really made sure they did it right. You know, you can't be off by 5%. 5%, and you'll sink the company. So you couldn't be off by very much. And so, you know, they were very, and then you have the other side of it. People who are getting the pensions are also very interested in getting the correct amount. You know, they want to know how much they get. So if you short them, you're going to hear about it. So, you know, you had really interested parties on both sides that looked at the calculations for these, and I think that's probably why there wasn't very much of a problem with them. Okay, let's do the last one here, and then we'll go to something a little different. All right. So let's go ahead and make the actual gains and losses. By the way, what's a little bit unusual about number 9? It's not crazy unusual, but it's a little bit unusual. This is actually overfunded. At least at the beginning of the year, it's overfunded. Okay, so we have an unexpected loss of 2,000. We have an actuarial loss of 22,000. So what's the journal entry going to be? Anyone? You guys are.
Do we flip the pension asset liability?
Yep.
Because it's a loss? Yeah.
Yeah, so pension asset liability, okay, so this will be actually a loss. And then the pension asset liability will be the credit side, which is a liability, basically. And again, this is the unexpected loss, 2000. Oh, it did all in one fell swoop. Okay, and we gotta start adding some other stuff up. Okay, so prior service cost was, scratch that. It's just plain service costs. This is the current year. So this is what the employees earned over the current year, 70,000. This is probably messed up too, isn't it? It is. I gotta check and make sure that I didn't mess up on the tests. They said they had a big deal. Okay, so service costs is for the current year. So in the current year, 2023, this in 2023? Yeah. They earn another $70,000 of pension. Interest on it. $77,000. So this adds to the pension expense. The 77,000 adds to the pension expense. The expected return of 120,000, this lessens it. And the weird thing is, in the pension expense calculation, is that we use the expected return. Amortization of prior service costs, 15,000. That's gonna add to it. And we don't have any of these. All right. I don't know what that is. $42,000. And again, you look at this and, you know, part of the reason is they have this huge expected return on assets, and it looks like their assets are really, I don't know what they're investing in, but anyway, their expected return on assets is very high. And their assets are very high. So there's an awful lot of these expenses that are in liability that are going to be covered by these assets, this planned asset. Okay. So pension expense. Did you guys get 42,000? Right? 92. Yeah, I think that's right. Okay, how much cash did they throw in? Oh, they're still throwing in a bunch of cash too. Their cash are throwing in 130,000. There's a private service cost. Private service costs, you can just call this PSC is fine. Abbreviate it. And we just 145, 103,000. A big reduction in our pension liability. Or an increase in our pension asset. And this is a plug number. And I'm sure you guys have picked up on that. You know, one of the reasons why they say asset or liability is because this can flip back and forth. Sometimes it'll be a liability, sometimes it'll be an asset. So you just have it as both. And you'll notice that up here too, right? I mean, this is a credit, 24,000. That means the liability is going up by 24,000. This means it's going down by 103,000. I don't know what the which was sitting in there, but all right, so that's the wacky world of pensions. And the big thing there is to remember is that this is just the beginning projected benefit obligation. This is the best estimate of what the liability is for it. And by the way, there are criticisms of this method of using the PBO. This is called PBO. There's other ways of calculating this, but PBO is the one we use. The projected benefits obligation are you project into the future with the number of employees that you have and their future salaries. You know, when they retire, that's included in the calculations. Now, one reason why a lot of people, or a lot of business people anyways, don't like that is that a lot of times that they're downscaling, they're having fewer employees. So they're not going to have as many employees. Look, we're not going to have 28,000 employees. We're going to have, 17,000 employees in the next 5 years. That's all we're going to have. So you're projecting on a lot of people that aren't going to be there, and that's not going to be their last, wages are on it. And also, a lot of times now they're also having give backs. A lot of times these unions keep the jobs and all that kind of stuff. They do a lot of give backs, and so a lot of times the projected benefit obligation people will consider that to be inflated for at least for some companies. But that's what we use, and it's kind of. I'll tell you there was something else that's kind of funny about all of this. So when I was going through, they were sure that these pension obligations were going to sink all the U.S. companies were going to go bankrupt. But notice something: those liabilities were there whether you put them on the books or not. Just because you put them on the books doesn't mean magically they appear. You can't just put a journal entry for cash on the books and cash magically appears. So really all you're trying to do is give information to people. That's all we do in accounting. And so it is kind of funny that people were so worried about it, as if you don't put them on the books they don't exist. Kind of an idea where all the analysts knew that General Motors owed X amount of dollars in pensions, but the idea of putting them on the actual financial statements was really something they put over. And just to give you a clue as to how big the fight was, basically, that it took something like 13 or 14 years to actually come up with kind of a way of accounting for it that companies and everybody could agree on that that was okay. So that it took a lot of getting used to it. As you can tell, this was like, I think, really the first really involved calculations that we had in accounting. Before this, it was sort of like here's an obligation and here's an expense and that sort of thing. Whereas this was one that they kind of had to work around. And the big thing was that, actually going back to the first page, was that the pension plan was separate from the company. This was separate from the company. So separating them out, really helped with the calculations of it. And I think that they're very, it isn't like they're watered down, they're still very accurate. Okay. Prior year service costs. This is when they give money to employees in their pension for service they did in the past. So instead of paying them $10,000 every year that they worked in the past, they'll pay them 11,000. Now notice that those people have already worked for those, 10 years, 12 years, 20, whatever it was. Those are prior service. So the question is, well, why are you giving it to them now? Well, you're giving it to them now based on their future service. So yes, it's going for the calculations for prior service, but the reason you're doing it is because of the future service, selling this contract or whatever it is, and going into the future. So you amortize it, you spread those costs out over the future. And that's what we're looking at doing. Okay. So we have these employees. Future years of service, 4413. Okay. So on January 21st, the company amended its pension plan, increasing the projected benefit obligation from 1 million to $1,240,000. Okay, so the increase in the pension benefit obligation was how much? How much did it increase by? Oh, you guys know this, you're toying with me. Put it in chat. You don't want to say it out loud.
You ask how much it increased by?
Yeah.
240,000.
Yep. So this will be our, our increase in it. This will be our prior service cost. So this will be, subtract those. Okay. Clean this up a little bit. So this will be our prior service cost that we are going to add on to it. Now this is the total prior service cost. Okay, now how many future years of service are we going to get out of these people? So we have Amy, Bill, Kathy, and Doug. Is that 12 total? So they're going to be 12 total service years. So we're going to calculate how much is it per service year. It's 240,000 divided by 12 future years of service. It's 20,000, I think. Let me fix that one up. Okay, so each of their prior service years, we're going to give is basically going to be amortizing $20,000. Okay. Okay, so this is how we're gonna calculate this. Now, in 2023, Amy's gonna be there, Bill is going to be there, Kathy's gonna be there, and Doug is gonna be there. What is that, 4? Let's go to 2024. Amy's still gonna be there. Bill is still gonna be there. Kathy is not. Kathy retired. Doug is still gonna be there. 2025. Bill's there. Kathy still hasn't come back. Doug is still there. And 2026. Amy's still there, Bill's still there, Kathy is still gone, and now Doug's gone too. All right, does that equal 12? Yes, it does. Okay. So this is what we're going to amortize in each of the years. So 2023, there's going to be 4. 2024, there's going to be 3. 2025 is 3. 2026 is 2. Why am I not lining up? Okay, there we go. We're going to multiply those by 20,000. Four times 20,000 is 80,000. Three is 60,000. Three is still 60,000. 2 is 40,000. Just to check and make sure, I just want to make sure that this adds up to, did it add up to 240,000? 120, it does. Okay, so this is how much we're going to amortize each year. So 2023, we're going to amortize. I should label this. No, I should put in an extra row is what I should do. So 2023, we're going to advertise 80,000 on it. 2024. How do we do this handout? $2025, we'll do 60,000. And 2026, we'll do 40,000. And so the idea is we gave this 240,000 of prior service costs. We gave that to them to for their future service. So these are future years. So even though it's looking backwards at previously what they had worked, the idea is the reason we're giving it to them is for future work. Question on that thing? All right. I'll tell you what, I'll let you do this one on your own. We'll go ahead and take a break. Go ahead and do this one on your own, take a break. We'll say be back at, what time was it? 6:48. Let's say be back at 7. Yeah, but give it a shot, see if figure out the number 11. And I'm going to send out the practice test. Give me 1 second. Oops. I should probably put it up. And by the way, just so you know, the exam is only going to be problems. That's all we're going to do. We're not going to do any multiple choice essay type problem. Yeah, I don't mind. I wasn't talking. I was just kind of filling these in. So yeah, this is we should have gotten for number 11. And again, you know, the whole idea is that you're, even though this is for prior years, that you're actually going into the future. The reason you're giving it is for future service. Okay, and so you're just taking this $100,000 that you're increasing it by, and you're spreading it out into the future. And this is kind of how you're doing it. You're doing it for, you know, these years, and so this is how much you're going to do. So the first year, 2023, you're going to have this amortization of prior service costs of 30,000. So what we're talking about is this entry here. You know, this is how we came up with this entry. Amortization of prior service cost. So the first year we'll have 30,000, second year 25, 25, 10, 10. And so that's how they're, you know, that's how they spread it out over the future. Any question on that? All right. Let's go to practice exam. And this is just kind of going to go over the deferred taxes just to make sure we're okay with those, and then do a couple problems like we just did or similar to what we just did. Okay. So let's go to, oh, are there any questions on this one, by the way? Number 11? Okay. All right. No. So this is the practice exam. And this is kind of the way, if when you see it on the CPA exam, it's not going to be laid out like this, but you can, that doesn't mean you can't put it into this kind of a format. So one thing I like to always do is do the permanent differences first and then do the temporary differences. It just keeps them, it makes it easier for the journal entry. Okay, so this one we had a pre-tax financial income of 200,000. Depreciation on a tax return is greater than on the income statement by 30,000. And the enacted tax rate for current and future years is 30%. Okay. So our pre-tax financial income is 200,000. We don't have any permanent differences. So this will be our income for our tax expense. What is that, 60,000? So that's our income for our tax expense. Now we have excess depreciation. So they're allowing us to depreciate more, and they're doing that to make, not to make, to help us, to encourage us to buy equipment and keep everything, people employed and all that kind of stuff. And so this will be our taxable income or taxes payable. Oh, income tax rate is, they gave that to us. Okay, so this is a temporary difference. This is going to reverse out in future years. By the way, in all the problems I give you, the current and future rate is going to be the same. And a lot of times you'll find that because it only goes by the enacted rates. And a lot of times the enacted rates are, the same. You'll often hear Congress talking about changing the tax rates and stuff like that. Not until they're enacted do we actually use those. But it is possible. Let's say the enacted rate was for future years was 33%. We would multiply this by 33%, and this would be a plugged number. Actually, the expense would be a plugged number. But oftentimes you don't know those things until going into the future. And by the way, if they do change the rate in the future, when they change the rate, that's when you make the you alter whatever the deferred asset, tax asset, or deferred tax liability, that's when you make the change, when they actually change the enacted rate. If it's not enacted, you don't change it. Okay. So we have pension expense, or not pension expense, tax expense. $60,000. Taxes payable. So in other words, what you're gonna write the check for this current year is 51,000. Okay. This deferred taxes, is this gonna be a deferred tax asset or a deferred tax liability?
Liability.
Yep. Yeah, we got out of paying $9,000 this year, but this is gonna reverse out. When this depreciation, these temporary differences reverse out. So when they do reverse out, at some point, we're gonna have to pay off this 9,000. Not this year, we only owe 51,000, but in the future, it's gonna reverse back out. Okay, so on the test, you're gonna get one like this. This is a fairly easy one. Then we go to the terrible, diabolical, evil. Something messed up with my spacing here.
Professor, can you go up for just 1 second? I just need to see, both almost lapping going up. That's good. That's good. Thanks.
You're welcome. There's something funny with the spacing on this thing. That's right. I know what it is. You know what it is? Whenever you find weird spacing on a Word document, if you go into the page layout and check the spacing and all that, but if you come up here to this Windows Orphan thing, unclick all these. Yep. Oh, oopsie daisy. Let's undo that. Okay. Like I said, never do that. Never ever do that, or you lose your whole document. All right, enough goofing around. Okay, so second one. This is the more involved one. Pre-tax financial income is 400,000. Depreciation is greater by 50,000. Rent. It's greater than rent earned on the income statement by 20,000. EPA fines are 6,000. And the tax rate in current and future years 40%. Okay, so let's go through here. Pre-tax income was 400,000. Fines and penalties. We have this EPA fine of 6,000. Now we had to expense that or put it as a loss on our income statement. But the IRS, they kind of take a dim view of that. They say, look, we're not going to give you a write-off because you broke the law. So fines and penalties are never going to be allowed for tax purposes. You pay the fine, you're not going to get a tax break for paying a fine. So our tax expense income is, we have to add this back in. So this is our tax expense income. And that's never going to reverse out. It's not a temporary difference, it's a permanent difference. Oops. So that's gonna be your tax expense. 162,400. I think it's yellow up here. Yeah. Okay. So coming down here, we have excess depreciation. Okay, so this is going to subtract from our taxes. What is it? 50,000. It's 20,000. Okay, rent collected in advance. Now, this is when they're actually going to make us pay on unearned revenue. So someone pays us in advance, 20,000, okay. The IRS's view of that is, look, you got the cash, you can pay the tax on them. $8,000. Ah. Actually, it's 40%. Okay, so this will be our taxes payable income. Okay, 406,000 minus 50,000 plus 20,000, whatever that is. No, 376,000. $150,000 for it. This is confusing. Hold on a second. I'm gonna do something here. Let's make this green. We'll make this blue. So we kind of pull those two out. Okay. Now, these two, be careful on these two because you're going to enter these separately. And I'll show you why in a second. Okay, so let's say, take a look down here. Well, let's do the easy one. Tax expense, 162,400. Let's jump down to taxes payable. The liability going up. $150. Okay, this excess depreciation, is this going to be a liability or an asset? The 20,000.
Liability.
Yep. Liability going up by 20,000. And the rent collected in advance. Now you can kind of think about this that we're paying on this rent before we've actually earned it. So it's a little bit like a prepaid. you know, it's a little bit like a prepaid, so this is gonna be a deferred tax. Asset, and it's sort of like a prepaid. We paid the tax ahead of time on it. This would be a good idea to add these up and make sure they balance. 162 plus 8 is 170. Oops, 400. And 174, okay. You don't have to put that in, whenever there's a bunch of entries, I do it. Now, if you're wondering why, you know, why don't we combine these two? You know, why don't you say deferred tax asset and deferred tax liability and combine them? Well, the reason you don't, deferred tax asset, this is for rent collected in advance. That's probably short term. I imagine that that's for next year's rent. It's possible it goes further than that, but this is probably going to be a short term. Whereas this one, the deferred tax liability for the depreciation, this might be many years down the line. So this could very well be long term, whereas this could be current or short term. So you keep them separated so that they because they might reverse out at different times. All right. Hey, look at one of these. Just had one. All right, let's see here. 8. 9, 17. Oh, I get it. All right, so coming down here, the projected benefit obligation goes up by 170,000. No, it doesn't. Yeah, it does. So the increase 170,000, and then we're going to say, okay, well, how much is it per future year? $10,000. So every future year, we're going to amortize $10,000. Okay, and we go back to this thing. 2023, Ed's gonna be there, Paul's gonna be there, Ali's gonna be there, Maria's gonna be there, Tom's gonna be there, and Sarah's gonna be there. Was that 6? 2024, Ed's gonna be there, Paul's gonna be there, Ali retired, Maria's gonna be there. Thomas is gonna be there, Sarah is still there, although not for long. She's gonna retire too. 3 years out, Ed, Paul, well, he's still retired. Maria still there. Tom is still there. Sarah is no longer there. Ed's not there. Paul's there. Thomas is there. Does that add up to 17? 11 and 6, it does. Okay. Okay, so future years, we have 6, 5. Not 5, 4, 2. $60, $120, $170. Okay, that does add up. So this is what they're gonna advertise for each year. So 2023, 2024, 25, 26. So you're gonna have that. And this is gonna be the amortized, how much you're gonna advertise. Oops, for more ties. So first year, we're gonna advertise 60,000, second year, 50,000, then 40, then 20. And again, even though this goes for prior service, for something that happened in the past, excuse me, the idea is that we're giving it to them now for future service. And it is possible these are negative. If there's a pension give back, like it was from 600,000 down to 500,000 or whatever, these could be negative amounts. Okay. Now, with the bizarre one. It's not bizarre, it's just there's a lot to it's a complicated area. Does anyone know anyone who's an actuary? People are good in math, a lot of times end up being actuaries. There's 10 tests. At least there used to be. I don't know there's still a lot, but there used to be 10 tests. You go through the 10 tests and then you be a licensed actuary. And I guess the first couple tests aren't too bad, but 3 through 10 gets to be a little bit more fun. Okay. All right. So first thing we gotta do is this actuarial gains and losses. We expect a return on assets of 56,000. Actual return on assets is 59,000. So let's see, that is a gain. Spacing got all messed up here or something. Oh, I know what it is. What it is. All right, I think a gain of 3,000. And we have an actuarial gain of 7,000. Okay, so what's the journal entry going to be? It's overall, it's gonna be a gain of what, 12, no, 10,000. Here's a good thing to remember. Gains are always credits and losses are always debits. So this is gonna be a gain. The comprehensive income. And gains are always, we'll put that in right here. Gains are credits. Losses are debits. And that's not just for this problem, that's for everything. Gains are credits, losses are debits. So in this case, we have a gain. And here we have a pension asset / liability. Oops. And if it's an asset, it's increasing with a debit. If it's a liability, this would be decreasing with a debit. It depends on whether there's an asset or a liability in this account. We really don't need to bother with that though, because if we just put this account in as pension asset liability, it's covered. Whatever it works out at the end, the ending balance, if it's a debit, it's going to be an asset. If it's a credit, it's going to be a liability.
So in this case, it's a liability, right?
Well, it's either going to be a decrease in a liability if it's on the debit side,
Right.
it's going to be a decrease in a liability, or it could be an increase of the asset if it's on the asset side. It depends on what's sitting in the account right now. Now, if there's nothing else sitting in the account, it's probably going to be an asset. But I think there is something sitting in the account probably, because it looks like there's a accumulated comprehensive income so far of 13,000. So it depends on what's in there.
Okay.
But yeah, and by the way, I know that it looks kind of funny. Pension asset liability, like which one is it? Well, it could flip, and that's why they usually have this as a combined account, because it could flip from one side to the other. And so whatever you run up, and at the end of the period, you look in that account, you see what the ending balance is in it. If the ending balance is a debit, it's an asset. If it's a credit, it's a liability. If it's an asset, it's a little bit strange that it goes with other assets. It does not go in any of the property, plant, equipment, or any of these other ones. It's just called other assets. Okay. Well, I know that I gotta check the tests. I don't like this is not formatted right. Okay, I'll look into it. My problem, not your problem. My problem. Okay, so pension expense. So service cost is $60,000. So that's what they earned this year. Hey, I changed you. Wait, all right. Interest on benefit obligation. That thing times settlement rate is 10%. At the beginning of the year, this one was overfunded also. And more assets than liability. Okay, times 10%. 51,000. Okay, so service cost increased our expense by 60,000. Interest on projected benefit obligation increased it by 51,000. Our expected return on plan assets, I'm gonna change this to green now. 56,000, and again, the weird thing is, it's the expected return. Prior service cost amortization, so this is what we were talking about up above. That's what these are. Like I say, that's what these are. Okay. In fact, I'm gonna turn it blue just to match it up with that up there. Okay, so this will add 11,000. And this one's in this class, that's always 0. It's possible that someplace else it's not 0, but all right, so 60,000. Okay, let me try this again. Came up with a crazy number. That's better, 66,000. Have you guys got, hopefully? Yeah. Yeah, I think that's it. Okay, so we're gonna have pension expense. Oh, 66,000. The contribution, so this is cash. So the cash is going to be 54,000. Yeah, let's make that blue. So cash is 54,000. And notice that the contributions are not included in the pension expense. It doesn't, even if you put in 0, you're still going to have this pension expense. Cash asset going down 4,000. Amortization of prior service costs. And you feel free to just put that in as prior service costs. And that's 11,000. And the reason that's 11,000 is in this pension expense liability, at some time in the future, scratch that, sometime in the past, these prior service costs, the entire amount was dumped into this pension liability. So now we're recognizing it, we're going to take it out of that liability, it's going to be expensed. And if we didn't do that, it would just it would basically be double counting it. Okay, so let's see, what is it? 65. That's 60, oh, we need 1,000, this right? Yeah, okay. Pension asset liability, $1,000 credit, so that's either decreasing an asset or increasing a liability. And again, we really don't have to worry about that, whatever it takes out to. And you'll see sometimes they'll flip from year to year. This is a plug number. Question there? Okay, it just occurred to me, I don't have this in the Blackboard. Here, want to see how I make an assignment? So this will be due on 5/5. And the files that I should have added earlier. Okay. And I'll also do it in a second, I'll add the exam in. Okay, is there any questions on this thing? That is the problem we've been looking for all semester. That's the last problem in the class. Okay. Hey, look at that, even early. All right, so I'm gonna be sending out the exam for chapters 18 and 19, the ones we just did the practice exam. That was very similar to that practice exam. And that is due by a week from Friday. And that's the last thing to turn in. Again, next class, I will be here next class. It's optional. You do not have to attend the next class. Well, you don't have to. It's still America. You don't have to attend any class. But I'm not going to cover any new material next class. But if you want to, if you have questions on something or want to go over something, or feel free. I'll be here, and you can tune in and at 6 o'clock, and you can go over anything you want to go over. Any questions on that?
I don't
Okay.
have a question
Okay.
on that, Professor, but I sent you an email. I don't know if you got a chance to send it or if I sent it to the wrong place.
Oh, no, I haven't sent it yet. I'll send it.
Okay.
I'll send it tonight. I will send it tonight.
Okay.
I
Alright.
forget about it. Actually, I was talking to somebody about it today.
Okay.
Yeah. I will send that out.
Okay. Thank you. Have a good night.
I will, you too. Anyone else? Okay. All right. Well, see you guys, and
Good night.
I'll send out the test will be coming shortly.